Let's get started. Ray has a lot to talk to us about, and we have limited time, so let's get started. Ray is going to tell us about whether or not we're making money, and that's really kind of an important topic, isn't it? Understanding financial statements and sustainability. Am I making money? Thank you for coming. Let's move on to our next slide. There we go. What is SCORE? A little bit about SCORE. We want to tell the world about what we do and how we do it. We're a national organization that's part of the SBA, and we provide free confidential business mentoring, both in person and online, and a host of business educational services, including these amazing workshops. And you'll hear more about our website in a little bit, which has a plethora of information on it. Our chapter, the SCORE Minnesota chapter, has over 90 volunteers, and we serve Manatee and Sarasota counties and have done so for the last 50 years. Our chapter, we're very proud to say, has been recognized as a National Chapter of the Year and as a Diamonds Chapter, which is the highest accolade that can be given to us. Since 1964, SCORE has assisted over 11 million clients. And if you are a small business, contact us to find out how we can help you with our free mentoring. We help businesses in all phases, whether it's the pre-startups, you just come to us with an idea. In fact, this afternoon, I have a SCORE mentoring session with a brand new client who's thinking about opening up a business. Or are you already in business? Are you opening it right now? Or are you trying to grow your business? Or are you at the point where you want to sell or close your business? We have specialists that can help in every step of the operation. How do we do this? Well, we pay the bills from our sponsors and community partners along with the SBA. So if you can, please try and support these wonderful organizations. I'd like to present Ray Vicks to you. He's an amazing presenter. I have heard him, and he's got a lot of knowledge that he's going to be sharing with us. For over 30 years, he was at some of the big four CPA firms. For 3 years, he was a CFO in Washington, D.C. Based healthcare. He's got, of course, extensive experience. You ask him about these reports and he just starts to beam thinking about them. Currently, he's the sole principal in an LLC to provide strategic advisory services to business executives and boards. He's on a couple of boards. He holds a BS degree from Virginia Tech, and he's a licensed CPA in multiple states. What more can you ask for? And a dynamic person. So let's get on understanding financial statements and sustainability, or as we like to say, am I making money? Take it away, Rick. Ray.
It's the Ray and the Vicks together. That puts it all together tightly. Thanks, Diane. And first and foremost, I'd like to thank each of you for participating. That makes it fun, and that's what I enjoy, and I think it's probably the reason I'm here today, is I enjoy this interaction. I know my topic, it's about financial statements and things like that, accounting. Most people don't think those are too exciting, but they're okay. So I like to start this by saying, why should you care? Right. So and maybe I mean, there are 6 questions raised here, and maybe we should just take a quick moment and explore as a group, let's say, as a group of business owners and operators. So are your financial statements important enough to warrant your attention, your focus, action? I think another way of posing this question is to think about your familiarity level with financial terminology. Right? Or are you a financial expert? I mean, when the day's over, right, you're either launching or have launched it or running a pretty complicated business, or are you a financial expert? And I think, most important, once you get past those questions, those are the qualifying questions. I think the really key question is, could you speak just at the moment, right, as to the health of your business, right? I think that's a fair question at any point in time. And this goes beyond intuitive thought. This gets to the question of how's the business doing, right? Really, how's it doing? So let's proceed. Let's continue here, and let me stop for a quick moment. I figured I'd take maybe 30 minutes or so and walk through these slides. If you have questions, go ahead and pose those. If it's something you want me to really pause and respond to immediately, I will do that. Otherwise, we're certainly going to leave at least 15 minutes for Q&A is the objective. Okay, so as Diane mentioned, show me the money, right? Okay, I mean, now this is where the language of business becomes important, right? And where the terminology is important, because, you know, if you really look at it, as a business owner and founder, you know, your performance really is about what's reported in your financial statements. Your bankers, your partners and fellow investors, perhaps some of your suppliers, customers, they'll all measure your success as a business owner by examining your financial statements. And I like to say this. I mean, when I say it's the language of business, I say this is where the buck stops here, right? Because this is about your money, and to best position yourself, it's good to both understand and then also be able to speak the language of finance. Okay, so that said, let's go ahead at some financial statements. We're actually going to do some quick walkthroughs. I just want to kind of set a stage a little bit. So the business report cards, I mean, that's how I've heard it referred to often, right? And so I think that's what they're about. I mentioned these users in the previous slide. I think another one I'd toss in here that I didn't mention are regulatory agencies. You know, depending on filings, I mean, at a minimum, we all file tax returns. So we've got the IRS, but we've got state agencies, et cetera. Often they're going to be users of your financial statements too. And that's good. And that's important. But to me, the most important thing is that your financial statements should be a business tool for you, and it should be strategic, and it should be as important as other tools you use to effectively run your business. Okay, so we're moving to the financial statements and what they show. Okay, so you will hear people say that there are 3 basic financial statements, all right? And you say, well, but I see 4. Fair. All right, so the income statement, the balance sheet, and the statement of changes in equity, those 3 are referred to as the basic statements. But you will also often see what's called the statement of changes in equity. You could cover that in a balance sheet, but often it gets busy. It's harder to follow. So people will carve it out as a separate statement. So while it's not referred to as one of the 3 basics, it is, you're typically going to see it among a group of financial statements. Okay, and I think, you know, essentially this gives you a sense of what's contained in them, but we're going to walk through that a little, so I won't do it now on this slide. So let's move on, and let's start with the income statement. You know, we've all heard of these. We've heard people refer to them as the P&L or the profit and loss statement. Couple key points. An income statement is for a period of time. Okay, so if we were going to get visual, if you will, let's call it a film, a clip of that has motion in it that's happening over time. It's the results of your sales, what it costs to produce the sales, what are your margins, what are your SG&A costs. We're going to get to some of this terminology. I'm just introducing it now. And then when the day's over, right, what's your bottom line? But always for a period of time. And that's usually going to be monthly, quarterly, or annually. This does, though, get to our opening question. Am I making money or not? When you get to this last bullet point here and you talk about net income for the period, that answers the question of whether or not we're making money. Okay, let's continue on the income statement, and let's go ahead and do a quick walkthrough here, all right? I mean, because we can start to put some of this in context. So, you know, and the numbers, this is going to sound strange. The numbers are not as important as the picture that's being presented here. So we're going to be analysts. We're going to look at this income statement and we're going to think about what it's saying to us as opposed to what the individual numbers are. So first of all, I would look at it and I say, okay, this is a manufacturing company. They say, why? And I say, well, if you look at you've got your sales of about $500,000 here. The very next item, or cost of sales, that's not the type of a section you're going to see for a company that's in a services business. Cost of sales is typically going to be either a manufacturing concept or a retail concept, because it's the most important cost in that environment. Okay, now, so why is it a manufacturing company? Because when you look at cost of goods sold, they've got materials, and they've got labor, and they've got overhead. But then I start looking at proportions, right? The total cost of goods sold is $320,000 approximately. The largest component are materials. So that speaks to some type of a business where perhaps your input is a partially completed unit. And then you have to apply labor and some overhead to it to finish it before you can sell it to your end use customer. So that's the numbers there are not as important as the relationship of the numbers to one another and what it tells you. So I look at now I go down and I see they've got SG&A expenses. We're going to talk about that more, but those are selling, general, and administrative expenses. All companies have them. When you look at these expenses, you're going to see, just by their nature, some of these are what we would call variable costs, and others are fixed costs. Variable costs are much more controllable in the moment and on a day-to-day basis, whereas fixed costs are controllable, but not necessarily immediately. Example might be rent, right? You can control that cost, but maybe annually when you can make a decision about whether you want to continue the lease, or some other expenses are easier to control in the moment. Perhaps travel is a good example. All right. So those are the types of expenses. I like to, the key thing I like to point out about SG&A expenses is that as an owner of a business or its most senior manager, that's where you have to have your hands there and around those costs, right? Because that's going to make the difference in terms of your pre-tax income. Sure, you want to drive sales. It's going to cost you a certain amount to produce your sales. But when the day's over, you can best tweak and impact that line item down below that says pre-tax income. You can best impact that by how you control the expenses. In this example, they clearly have about a 25% effective income tax rate. So that's how they're getting from that $63,000 to a net income of $47,000. Okay, all right. We'll come back to these guys. One thing I would say, Diane, can you flip back to that quickly? One other thing I meant to point out. Okay, like if you look at these guys, we're going to get into some proportions and percentages later. This company generated a pre-tax income of about 12.5%, and their net income is about 9.5%. And I would say, given that they're a manufacturing company, my overall reaction, if I kind of looked at this as a banker or an investor, I'd say, well, it's a well-run business. Okay, so just something to think about. Okay, let's go to the next statement. We're on to the balance sheet now. So if you wanted to think of an income statement as sort of a film clip or a video clip, I think of the balance sheet as a snapshot. All right, it's at a definitive point in time. Your balance sheet is as of, whereas your income statement is for the period ending. So you can see the difference in what you're portraying in those types of financial statements. So a balance sheet, if you really get to it right, it's about your assets. That's what you own. And it's about how you paid for them. And that has to at some point be synced so that they're equal, because essentially the only thing that you pay for are your assets, and so there should be parity in that equation. All right, so how do you pay for assets? Either the owner makes an investment, we refer to that as capital. You could use credit, right? Borrowings to get some efficiency. You could use this year's earnings, like the company we show, they have a net income of 47,000. They could use that to buy assets. Or if the business has been around for a bit and it's retained earnings over time and it's sitting in the bank, they could have used that. But when the day's over, their assets are going to be equal to their liabilities plus their equity. The liabilities are going to be instances of where essentially you're using credit to acquire assets. Equity is going to be when you're using the owner's funds. Okay, this is a closed equation. Okay, assets have to equal liabilities and equity. Okay, that's good, Diana. And let's go right there, because now we're going to walk through a balance sheet. Let's start at the bottom, right? Our total assets, 351, liabilities and capital, 351. In this company's case, now let's stay on the right side now. How did we buy these assets? Our total capital here for this company is 86,000. Its total liabilities are 165. So we used the combination of both equity and credit to acquire these $351,000 or so of assets. Let's go to the left side and let's look at the assets for a minute. I look at this company, their current assets are about 96,000. And then I'm going to quickly go right over, because, right, we're an analyst, right? If I go over to the right side, I say, well, what are their current liabilities? 35,000. And I say, okay, that's almost a 3-to-1 ratio. That's pretty good. That means that they have pretty good liquidity. They don't appear to be in danger of running short of operating cash flow, which, you guys are business owners, that can be dicey. All right. So now let's continue down on their asset side again. And I look at them, and this is consistent with what we thought when we looked at their income statement, right? Is that, see how much of their assets are in building and equipment, right? That's another sign that this is a manufacturing type company. That's where you have your primary investments, because you have to produce a product there. Now, let's go over and let's look at it and say, okay, but so they've got about 250 in fixed assets. How'd they acquire them? Okay, and in their case, they've got total liabilities here of 165. That it's only going to be the longer term ones used to acquire equipment. So see the long-term debt of 15, and then the mortgages of 115, that's 130. And then there's something up there above that looks kind of strange. It says CPLTD. That's the current portion of your long-term debt. It's just a classification thing. So really they owe 18,000 in regular debt and 115 in mortgages. So that's pretty good, right? They have invested in equipment somewhere around 250. They were able to leverage it some to the tune of maybe 2/3 of the cost of it, and the rest they had to use their equity to do. So they're using leverage efficiently, in my view. Nicely positioned there. Good use of the owner's investment along with debt to finance the company. Okay. I think I saw a question at one point about, must total assets always equal liabilities plus capital? And the answer to that is yes. So, in a way, it's almost, the terminology is, it's a balance sheet, right? It has to be in balance, because the way the accounting your accounting systems work, whether you're doing them manually or it's being done, electronically with software, every time you record something, there are two sides to every entry. It's called double entry accounting. And those entries have to equal one another in order for your system to even accept them. So by definition, when a year is over, assets have to equal liabilities and capital. If they don't, it means there was a misposting during the year. Okay, and we can come back to that and spend a little bit more time on it, but that is an important thing to keep in mind, is that yes, it's a closed equation. It's almost algebraic, if you like, right? You could always say that liabilities equal what? Capital, assets minus capital. Capital equals assets minus liabilities. But when the day is over, it's a closed equation and it has to equal. Okay, let me go to the statement of changes in equity. As I mentioned, this is not one of the three basics, but it's important. I mean, to me, it's important in that this, if I were an owner, I mean, you guys are owners of your businesses. If I were the owner, I'd spend time on this, because essentially this is looking at my ownership structure. It's showing, you know what, how profitable have I been over time? Have I made dividend payments? Have I returned capital back to my owners? Has there been additional capital bought in through ownership, et cetera? These are types of things that, are important to an owner. And that's why, while this isn't considered a basic statement, I like to talk about it and spend some time on it, because you'll always see it. So let's take a quick look at one. This one, I think, is pretty straightforward, but it lets us, go through our principles. Notice how this is what we call a roll forward in the world of accounting, or you could call it a reconciliation. But essentially, we're starting at one period, the defined period, and we're ending at another. In this case, we're starting January 1 of 15, and it's going to be for the period ended 12/31/15. So it's for that calendar year. All right, and essentially what we're doing is we're saying, here's how we started the year. We had 139 of total equity. 100 was the initial owner investment, and the company had accumulated earnings that it hadn't distributed back to the owner of 39. Hence, total equity section 139. They had no accounting corrections during the year. If they did, they would have to be reflected here. You always are going to have your net income or net loss, right? So that's going to be, in this case, is being added to retained earnings because they had net income. If they had a net loss, it would be a subtraction. And then you're just going to do the math. There were no dividends or withdrawals. So in other words, no capital went back out to owners. And so that's how you get to the end of the year. Essentially, you've rolled forward your equity from one point to another based on the activities that impact it for the year. Okay? All right. That's a statement of changes in equity. Okay, we're getting to the last of our regular statements. This is the statement of cash flows. If we're right, a lot of times people say, you know what, these concepts about net income, et cetera, are not particularly meaningful. What about the cash? And, quite frankly, if you're running a business, and I think a lot of times for lenders, et cetera, it really does come down to the cash. What's the quality of the cash flows for a company? It's not just what are the balances. How did it happen? And so that's what this statement of cash flows is about. It presents both inflows and outflows of cash for that same period of time that you do your income statement. And that cash comes from three sources. Okay, it comes from operating activities. Basically, that's running the business. That's your revenues minus your expenses. The next category called financing activities. As we mentioned, how do you pay for assets? Where do you get the cash? You can either get it through your operating activities, or you can borrow it, or you can contribute it, or you can get others to make capital infusions. And then the final question about your cash is, what'd you do with it? You can invest cash in a bank account if you like. I mean, that's one use of, you can invest your cash in a bank account. It's probably not where you want to invest it because the returns are not there. All right. So typically, instead, your cash is going to be invested either in property, plant, and equipment. That's what PPP is. That's usually going to be a manufacturing capital intensive company that makes big investments in PP&E. You may acquire other companies, etc. There are any number of ways in which you would invest your cash, but this captures it and allows some insight for both owners and others into the quality of your cash flows, both in and out. Okay, all right. So let's move on to our cash flow statement. All right. Okay. One more down. One more. Right there. Okay. Yeah, that's it. Okay. So
Did you see the question from Brad? He's in a service-based business and has job costing needed and does job costing and margin fall under this report?
The statement of cash flows?
Mm.
It would be more likely to get captured in the income statement. Because the business I was in, essentially we did some form of job costing because we were a public accounting and consulting firm. And so you have to be able to capture your costs to determine your own profitability. Because you have hourly rates or fixed fee revenue arrangements, and then usually your primary expense, if you're in the business I was in, is going to be personnel costs. But your personnel are going to be two types of personnel, right? You're going to have those that are deployed with clients, and you want to do job costing for them, and you're going to have those that are more in roles that are administrative to run the business as overhead.
So Brad's business is swimming pool projects.
Mm-hmm. So he's got construction in progress types of accounting things that he would have to manage. So, in other words, while he's building out a pool, right? Question is, at any point in time, how's that going, right? How's it going relative to expectations? And when you measure let's say you're using what is called the percentage of completion method. Let's say you believe that the pool is 50% complete, but you've already incurred 60% of your expected cost, right? Then you know that something needs to happen. Either there needs to be a renegotiation with the customer or something. But again, you're not aware that something needs to happen if you don't have the ability to track those expenses and to do costing by job. So he has to have job costing in the business that he's in. Someone has a question about WIP accounts. Yes, we used WIP accounts in our business though, because at any point in time, let's say we had a large fixed fee project, it's for the bigger firms, the arrangements, while you may do price sheets based on hours, but when the day's over, there'll be an agreed upon fee for the entire project, right? So let's say the project's going to be $1 million. Well, as you're proceeding through the project, we had to capture work in process types of cost data, both for ourselves and in some cases for clients. So like, for example, a lot of the big federal agencies, there was a requirement that at least on a monthly basis, you could give them that you could demonstrate to them what your work in process was measured in cost and also accomplishments towards the ultimate project. Yep. Okay. All right. So, but and again, we'll let's keep the questions going, and let me quickly get through this one. So this is a statement of cash flows. The best way to think about a statement of cash flows is that in the first section in operations, it's really just a conversion of net earnings to cash earnings. And we won't get ourselves caught up too much on what we had to do that, other than to look at the relationships. Our net income was 47,000, and our cash income, if you will, is 49. And the reason is the accounting rules require you to treat some things differently than you would in your bank statement. Okay, so, but in this case, you generated 49,000 in cash from operations. And then the next question is, okay, all right, I like to jump next to investing. So I've got 49 from operations positive that I could use if I like. I also, from a financing standpoint, I borrowed 140,000. So if you will, I have 189,000 to use in the business, if you will. It's just a way of thinking. Now, what did I do with it? Then I go to the investing section there in the middle. Okay, I bought 10,000 of equipment, and I bought a building, or maybe made a building addition of 111. So I spent 121,000 in total of my available cash into the business. So what's left just is your ending cash balance. Okay, so that's a good way to look at it. In this case, they generated 68 of positive cash flow. So let's say they started the year with 10,000 in a bank account. Well, at the end of the year, there'd be 78. They would have gone through this process to be able to reconcile how they got from 10 to 78. And it wouldn't be, the 68 isn't important. What's important is the quality of that cash flow. How much of it was borrowed? How much of it came from the owners? How much was generated by operations? And that's what I mean when I say this is an important statement for an owner. Okay. All right, so we've taken some time, right? And gone through financial statements. Some people call that a painful experience. All right. So I always say no pain, no gain, because this is what it's really about, right? Financial performance ratios, and some people call these key performance indicators. So you'll hear that often, that terminology, they call them KPIs. But essentially KPIs, or performance ratios, are those that an owner or manager might choose to monitor and manage their business. So when I say no pain, no gain, what I'm saying is that if you want your mind around your financial statements, because a lot of your KPIs and ratios come out of those. And so to effectively use that tool as an owner, you kind of have to begin to get into the language of the financial statements. So here's some terminology here. We're going to take a couple of these and just quickly explain them in a little bit more detail. All right, performance ratios. Cost of sales to sales. Pretty standard ratio that a company will look at. Retail organizations, manufacturers, etc. Bottom line is, for this company, 64% of its sales are absorbed by the cost of sales. Okay, and this is just something to be monitored, but it's also something to use to drive the business, right? Because you do want a sense of where you want this to be, so that then you know you're efficiently and in a cost-effective way generating your sales. Okay, so. But anyway, the math on that's fairly straightforward. You take that cost of sales number on the income statement and you divide it by your sales, and it yields the percentage. Okay. You want to use that as an early indicator. All right, let's go to another one here. Gross profit sales. You guys probably noted what we would call a reciprocal relationship between it and the previous slide. The previous slide was your cost of sales divided by sales. This is gross profit divided by sales. If you add gross profit and cost of sales together, that equals sales. So of course, it's going to be a reciprocal relationship where if that's 65%, this is 35%. So right, you could argue there's a redundancy here, but it may be that you're interested in what's the industry standard for the gross profit ratio in my industry, and it may be expressed in that way. And let's say it happens to be 30%, and in your example, you're at 35.5. You'd say, okay, I'm driving a more profitable business. But because you know that, then you can ask why. Now it's useful. If you don't know that, then there's no why question, and then there's no usefulness. Okay, in my view. Okay, let's
Could we go back?
Sure.
Could we go back one? Cassandra wanted to know if cost of goods sold translates to a service business.
Yes, it does. I mean, they're going to be costs. I'm trying to think of what would be. It's not going to be computed in a similar way. You know what I mean? I mean, cost of goods sold typically has to do with a process-oriented business where you're producing something that you sell, and or a retail type business where you buy inventory that then you're going to either do something to or not, but you're going to mark it up and you're going to sell it. Whereas services industries are a little bit different, right? Because sure, they have revenue. In fact, I slipped up a little with the terminology, but it's fair enough. Typically for manufacturing and retail type companies, people will talk about sales. For services companies, they typically say revenues or fees. It's a different type of stream. Yeah, it's a different type of business stream. As opposed to selling units, you're selling a service. Arguably, you're still selling units because a lot of times services are measured in hours or weeks or months for consultants, right? So, I would say generally for most services companies, you won't see cost of sales as a prominent item in their income statement. I spent a lot of time in the healthcare industry, and I'm still involved as a finance person with healthcare companies. We don't have cost of sales in our income statement. We have those significant costs associated with patient service, right? And providing care to patients. You could argue that that's the cost of sales, but it's counterintuitive, right? It doesn't necessarily work. So cost of sales is really more a concept, I think, for certain industries, and for other industries, it's not as important. All right, selling, general, and administrative. The only thing I would say here is that, again, that these costs a lot of times are more controllable than others. So in other words, if you're in a particular industry, your cost of sales, or let's take a healthcare industry, your patient services care costs are going to be comparable to the industry by definition, because you're all in the same market doing the same things. When it comes to your SG&A, though, type costs, that's where you can make the difference as an owner of a business to get the profitability where you want it. So again, I say this should really be paid attention to. The 23% here is just this example. Question would be, what's acceptable to you as an owner, and what are you trying to drive the business to? Okay, I'm getting to I think we're on the last one now. Okay, so, all right, so the old proverbial bottom line, right? This is the bottom line ratio, where you look at this and you say, okay, where do I want to be here? Right? I mean, if I'm a sole owner and I'm investing money in the business and I'm looking for a return from the business, would I be better off if I invested my money elsewhere? Right? Return on investment and net income are very, very closely linked when you're a business owner, particularly a smaller business owner. Okay, so that's the only thing I'd say about this. The 9.4% is not as important as being able to understand what this means how it compares to other industries and in your industry, and how it compares to your expectations. That's probably the most important question. Okay. All right. So that's that. The only other thing is just sharing some information here is that, so where can you find information like this, right? To compare, you guys are probably familiar with the SIC codes for different industries, right? And, so by those codes, then you typically can go in and get all types of KPI information and, comparable information for companies. One example that we give here, and I went and tried it, is basically through the library that you can, there's something called Mergent Intellect. And essentially, you go in, you register yourself, you get your login, username, you set up a password, and then you have access. It's like, I think, I'm trying to remember whether there was a fee. If it was a fee, it was pretty, modest. And what you can do then is you could go in there, put in a SIC code, and essentially you could decide for the following 4 or 5 items, KPIs, what is the standard in my industry? And I think you can even size it where it looks at, industries of different sizes. So let me see. Okay. All right. Okay. Nabil just mentioned that there is no fee. You can just join it right by joining the library. It was like getting your library card. So, all right. So, and here's some other information, and I think this is being recorded, and so you don't have to worry about quickly writing it down. Obviously there's tons of information out there. I have to say, for our website, that the information available there is remarkable. I mean, both in terms of links to information, embedded information, search capability. I mean, if I were going to look for some things, I'd just start there, and then you can always extend your search as you choose. Okay, I think I saw Brad or someone had a question. So that's it. I mean, we're into the Q&A now, so let's shall we, Diane? Shall we go with
before we
Q&A?
kick into the Q&A, I don't want to lose everybody, but I want to say that, yes, this is being recorded. Yes, you will receive a copy of it. Yes, you will receive the entire PowerPoint presentation, and you can look through it at your leisure. You will be getting a survey at the end of the webinar in the next few days, not today, in the next few days. And we'd really appreciate it if you would fill that in. What can we do to improve this? What other subjects would you like to see? And also, remember us, Minnesota Score, and think about who can benefit from our programs. Recommend us to friends and family who are starting businesses who need some advice. Our advice is free, but it's valuable. Also, if you would like to become a SCORE mentor, we would love to have you. You may not know about financial statements, but I bet you know a lot about other things that could help other businesses. So I just wanted to get that pitch in before we got to our Q&A. And actually, I don't see any questions. Brad would like your home phone number, I think.
Well,
so that he could talk to you.
I'll give him my mobile. It's also my home number. No worries. Sure, Brad. Let's talk sometime.
Okay, that's very generous of you, Ray. That's very generous.
Absolutely. So.
Okay. So we have no more questions. I just have one more slide that I'd like to.
Oh, Diane, I see there are questions popping up below in the chat.
Oh, just one popped up.
Yeah, I keep, it's been popping up pretty regularly.
Can you elaborate on what falls under COGS versus SG&A for a service-oriented business?
Okay. Oh, I can see these. I can click this chat button, and then I can see the questions. Okay. So which one were you on now?
I only see one question.
Okay. Okay, these must, okay, I see. These have been coming in as we've been going. So there are several.
Right, but
All
we've
right.
been talking about those.
Okay, well, sorry, is it being recorded? Okay.
Yeah, I think we covered all of those in the chat,
Okay.
except
All
for
right.
your number.
Except for the number. And should I put that in here? I don't
That's
mind.
up to you. Oh, you know what?
Um,
Brad gave you his contact information.
Okay, okay.
So let me see, Cassandra, what is the most basic place to start learning to read statements? A lot of this is over my head.
And so what was the question? I'm sorry.
What is the most basic place to start learning to read statements? A lot of this is over my head.
That's a good question. I would, you might, it depends on how far you want to go, right? What I would recommend that you do is that you probably have either a CPA or a bookkeeper, maybe someone, if you've got a board, maybe a finance person on your board. I always say that your best source to really get comfortable is interacting, if you will, one-on-one and being able to spend the time with a person. And that's what I would do. I would go to my accountant and I would, essentially say, why don't you walk me through some of the highlights of my financial statements, right? Let's say you use QuickBooks or something like that. Walk me through my financial statements. I think what you're going to find, at least this is what I find as I talk to clients, you guys are much more familiar with financial statements and what's in them than you may give yourself credit for. Because I think what happens is you look and you think, this is an accountant's thing and there are all these numbers around there. What you have that accountants don't have is an expectation. If you can launch and run a successful business, it's because you have good expectations about what the business should be doing, how it should perform, what it should produce. So you have a benchmark. And so the only other thing you need is to be able to take that benchmark and what you would expect and be able to look at a set of financial statements and draw conclusions. And the way to do that is just to get familiar with them. Your balance sheet, your income statement, and especially your statement of cash flows for your business, just spend the time with them. You'll find that intuitively you get it.
Pearl had a question about what expenses should be categorized as COGS versus SG&A for a service-oriented business.
Yeah, I think for a service-oriented business, I would say things that are costs that are directly related to delivering your service, then they're congruent to cost of goods sold or, COGS in a manufacturing or retail business, right? Now, so let's say I like to go to the example of you do, let's say you're a consulting firm, right? So your consultants are going to be the most significant cost you have. But that's going to be expressed as salary and benefits, right? So how do you put those into a cost of goods sold section? It gets to this concept of job costing that someone mentioned, is that those consultants are going to be deployed to work on projects. And so the question is, when you consider the cost of the person, their training, other related costs where it's direct, where they're performing projects for the client for which you get a fee, those are cost of goods sold. You're going to have other costs, right? You're going to have Let's say you have a bookkeeper who keeps the books. That's a cost. You're going to have rent if you have an office. You're going to have equipment, so you may have depreciation. Those are other costs that fit into the SG&A area. You may have some marketing type costs. Those costs are going to be probably the same type of costs across any industry or business. It's just going to be the proportion of those to total cost that changes from business to business. So the best way to look at it is that if you can identify costs directly related to providing the service, not indirectly, but directly related, that's congruent to cost of goods sold. But again, I would, a good source is I'd look at my industry, right? And I'd say, let's say I'm in the restaurant business. I'd go get several sets of financial statements for restaurants, being mindful of size, right? Because it's probably different depending on size. And based on a sizing that's comparable to mine, I'd say, what are they reporting? And how does it compare to what I report? You know what I mean? Because if you probably for a restaurant, you look at it and you say, boy, that's an interesting industry, right? I mean, what's the cost of goods sold? Are you a steakhouse? How do you do that, right? For a steakhouse, what's the cost of getting a steak to the plate, right? And I bet you guys, if any of you guys own a steakhouse, you know the answer to that question. How you portray that in a set of financial statements and capture it, you may not feel as comfortable with, but you know the answer. Because that answer makes a big difference in whether you're successful or not.
So we have one comment actually from Victoria, whether or not we could have a seminar like this specifically for nonprofits and boards. But I think, Victoria, your opportunity is in the survey that you get. That's your time to suggest additional topics, but we will certainly consider all topic ideas. We're always looking for ideas and looking for presenters like Ray who can make this all understandable.
Yeah, and I think Diana, last year there's a series that one of our mentors does for CEOs, or maybe several do. And so we did a version of this for CEOs. We also did a version for not-for-profits.
So if that's the case, you know where you can find it on our website.
Yeah.
Go to our website. Here's another plug for it, minnesota.score.org. You can see it on my screen right now. And there is a wonderful search feature. You can see the word search in the upper right side of your screen. You enter in any term and you're going to find webinars, you're going to find templates, you're going to see podcasts. There are all kinds of information available to you free just by going to our website. So I would encourage you to do that. If you want to find a mentor, go to our website and click on Find a Mentor. If you'd like to volunteer, if you'd like to help us, help you volunteer to be a mentor, or perhaps if not a mentor, what we call a subject matter expert, and you could be a great help. So use our amazing website as a resource. So look for your nonprofit there. What do you think, Ray? I think we've covered all of the questions, and people are saying you did a great job. Not surprising.
I appreciate all you guys. You let me do what I like to do, and you patiently have sit there and listen to it. But I enjoy this, and so you may be able to see that. Thank you.
Wonderful. All right. Well, we're logging off now, and I hope we get to see you next week. Don't forget, we have one more webinar in our financial series. If you haven't signed up for it, go to our website. Have I mentioned that? Go to our website and sign up for it. Look forward to seeing you again. Bye, everyone.
Bye. Thank you.